Hey everyone, Jeff McGInnis, Cross Country Mortgage. Welcome to May of 2024 and wanted to share with you what's been happening over the last month with rates and the indicators that we look at to try to predict rates and where they're headed. We're going to talk about inflation, we're going to talk about jobs, and I'm going to show you some charts. So let's dig in. So now we've got a look at we're going to look at the bond chart. So if you've watched this before, you know that up is good and down is bad for this particular chart that we're going to look at. And when I say that, that means that when the chart goes up, that's really good for interest rates, and when it goes down, then it's bad for interest rates. So let's take a look at this chart over the last month or so. And we've got right around April 9th is when rates started going up quite a bit. You can see that in that long line of red right after April 8th. And then you can see we were trading down below that line that's 50% for a while, a good chunk of April. And then we broke through that line of 50% that you can see, and now we're trading in between the line that shows that 38% and between 50%. So point being is it's been a bit of a wild ride in April. Rates popped up and now they're back down a bit. So we're hoping that trend continues, and as we go through time and space, we should see some improvement. If we look at inflation, which is a key indicator of what will be, so when inflation goes down, then it's really good for rates. When inflation goes up, it's not great. So you can see over on this chart that it's been a pretty flat line for the last few months of reporting. And so it's been a little bit harder to see some improvement in rates when the trend isn't as drastically downward as what the Fed would like it to be. And then we're going to look at some jobs. So now bear in mind, we don't want people to lose their jobs, but what we want to see is a right-sized of unemployment. And right-sized is, by all economic standards, or what I was taught, is about 5% unemployment is really safe for an economy. It's a indicator that we're chugging along nicely, not too hot, not too cold. It's kind of a Goldilocks unemployment rate. We saw a dip in unemployment, and then it popped back up in April at 3.9. So we're keeping an eye on this because inflation being a little bit frustrating, it's being a little bit laggy, but the job market is cooling off a bit, and we're seeing that the unemployment rate is popping up, which would help with rates coming down. So when we're talking about the Fed, they have a dual mandate. That means that they're trying to make sure that the economy is at maximum employment, which I'd mentioned in the previous slide is a standard of about 5%. And they are trying to create stable prices and moderate long-term interest rates. So their for inflation is 2%, and that's what they're currently with the current monetary policy. That's why they're not lowering Fed fund rates right now, because they want to see prices become a little bit more stable and then moderate long-term interest rates, meaning they would like them to come down as well. Now, if you have any questions, or if you would like to deep dive a little bit more on what's happening with interest rates, or if you would like to do some planning with your next purchase, be it an investment property, be it a second home, maybe you're up or moving down, I'm here to help you. I'm happy to share with you what your opportunities are and look forward to connecting with you. Feel free to reach out by email, text, DM me on social media, whatever works for you. I'm here for you to help. All right, have a great one, and I'll talk with you soon.